Okay, now come to next paragraph. Application of derivative in commodities. First is commodity market. Following are some of the differences between commodity market and financial derivative. Financial derivative you have learnt in SFM. Future option on stock index. Okay. And you have also learned commodity derivative. So what are some important difference between a commodity derivative and a financial derivative? So we'll see. In previous chapter also we had discussed something. In case of commodities, there is a storage cost involved. Okay. So while calculating the fair value of a commodity future, we have to also keep in mind the storage cost. Chapter number 6 we have solved few questions. Today I will take one more problem a little later where we will see the role of storage cost in the determination of fair value of a commodity future. Okay. So one question I have kept in this chapter also. Commodities, especially agricultural commodities, are perishable in nature and they require storage. Due to this reason, the buyer has to bear the cost of storage and transportation charges. In case if the location of goods is not in the same state, then the buyer also has to bear taxes and octroi etc. also. So what they are trying to explain, that sometime there can be delivery based settlement also, and then in delivery based settlement there is one more element which is there, storage. But for financial derivative, storage cost is not there. Do we need to incur a warehousing cost for a share or a derivative or a debenture? No. Do we need a transportation cost that in truck share will go? But commodities needs to be shifted from one location to other. So that is why while analyzing the commodity derivative, one has to keep in mind the storage transportation cost also. And in India, who has to bear the transportation cost? The buyer. In case if you insist on delivery, then you will have to arrange for the transportation, go to the warehouse, collect the commodity, and then whatever taxes also etc. are applicable, those have to be paid. So that is one difference between financial commodity derivative and commodity derivative. Second is the complexities. Compared to financial market, there is low volume of transaction and transparency in the commodity market, and thus often relationship between the future and the spot get distorted. So that means the theoretical future price and the actual future price may deviate from each other. In chapter number 6 we took few problems and we found that what we calculated and what it was available was different. Further, delivery in financial market is quite less cumbersome. Delivery in the financial market, if at all there is a delivery based derivative, you just have to transfer from one demat account to another demat account. But in case of commodity, there is an actual physical movement of the goods. It is not like a Amazon delivery. Okay, the seller has to deposit in a particular warehouse and the buyer has to arrange for the transport from that particular warehouse. These warehouses are located all over the country. So the exchange will assign the warehouse that from this warehouse the delivery has to be taken. So that is why there is complexity, and then it is not mentioned, but then all necessary regulations you have to follow. You have to get yourself registered under GST or local regulations, octroi if applicable, everything you have to take care of. So all documentation and other formalities are there in case of delivery based settlement for commodities. Next is higher cost. In case of financial market, the only cost is interest rate or exchange rate. But in case of commodity market, there are other costs also. Like for example, You have to take into consideration the transportation cost, delivery cost, storage cost. In fact, you should write insurance also. Insurance. Next point, physical delivery. Since the quality of goods or commodities even in two different batches cannot be same, the delivery of commodities becomes a challenging task. Commodities cannot be exactly same. Commodities cannot be, because these are produced. These are produced. Wheat cannot be exactly same. Sugar cannot be exactly same. Gold cannot be exactly the same. So that is one challenging task in case of delivery. But share can be exactly same. One share of Reliance is same whether you hold it or I hold it. Stating otherwise, this can be the principal distinguishing feature of the commodity derivative. That is, there can be multiple grades in case of commodities, but not in case of financial assets. Okay. This paragraph I had taken in previous chapter also. Prerequisite for future trading on a commodity exchange. Can railway ticket be traded on future exchange? No. Can movie ticket be traded on future exchange? No. Then what can be traded on future exchange? What kind of commodities are suitable for future trading in the commodity exchange? So one is durability. Commodity should be storable and durable. It should not be highly perishable. Then it will not work. Milk cannot be traded in the commodity market. Can we? Homogeneity. The commodity should be homogeneous in nature. If not homogeneous, there should be a specific grade so that buyer and seller know what we are exactly paying, receiving. Third point is free from control. There should not be government interference. Let the market decide the pricing. Then only the commodity market will flourish. And next is the volume should be high. There must be large number of buyers and sellers. There must be fluctuation in the price. Have you noted these points in the earlier chapter also? 6 number? Yes. Practically, it has been seen that despite the fact that same commodity possesses above characteristics, it is still required to be traded successfully. Okay, now we'll come to, like other chapters, trading and settlement process. You will place an order. Other party will also place a counter order. Somebody at the background will match the orders. Okay. So that is called trading and settlement process. So again I will go through it quickly because it is a repetition of your earlier chapter. The only thing is here is that you may have a delivery based settlement also. So in that case, how the delivery based settlement takes place, some additional information we are going to learn. So broadly, commodity trading involves three mechanisms. One is order matching mechanism. What is order matching mechanism? That once you place the order, the system will identify for this buyer which seller can be assigned. Okay. You will place the order. There are lakhs of counterparties. So the system will match the order. You want to buy at a particular price, there must be some seller who is selling at a particular price. So the system will match them. First, any trader places his or her order with any registered broker who in turn enter the same into online terminal. In case order matches with the opposite trader, you want to buy 100 grams of gold at 30,100. There must be somebody who wants to sell 100 grams of gold at 30,100. So system will match and the order is complete. The trade is said to be complete. Second is trade clearing mechanism. For matched order, clearing takes place through a registered clearing house. So at the back office, the clearing house will match the order and then they will arrange for the not delivery unless you want delivery. They will arrange for who will be the party who gains, he will get the difference, the one who loses will pay the difference. So he will follow up with the parties. The function of the clearinghouse is follow up, timely settlement. Delivery versus payment of commodity traded. Then next thing today you have to write what is delivery versus payment. From the name you can guess delivery versus payment. So write down, it is a settlement system. That means it is actually one party will deliver the commodity, other party will make the payment as per the agreement. It is a settlement system that stipulates that cash payment must be made. That stipulates that cash payment must be made prior to or simultaneously with the delivery of the security. It is written security, you can write security oblique commodity. Cash payment must be made prior to the or simultaneously with the delivery of the security or commodity. That is called delivery versus payment system. In commodity market, for certain commodities deliveries are allowed. So they will arrange for this delivery versus payment. And in case of non-delivery settlement, which is most of the cases, the winner should get the difference. The loser should pay the difference. So in case of non-delivery settlement through fund transfer. So this is what clearing houses do. Processing of delivery. Now somebody may insist on delivery based settlement. Like for oil, they want oil delivered, gold is delivered, okay, sometimes cotton is to be delivered. So few items the exchange allows to be delivered in case if the buyer wants the delivery. So what is the process? The process is that the main issue to be considered in the delivery process are availability of warehouse, and then from where the order has been originated, location of order, quantity of commodity deposited and dematerialized. Okay, then you have to enter in the system which buyer wants to take the delivery. You will mark it, how many units he wants delivery, which is the nearest warehouse or whatever warehouse the system will assign. The seller will have to deposit that commodity in that warehouse, and the buyer will have to arrange for the transportation and delivery. Further delivery process involves following steps. The buyer has to send a request to his depository participant to deliver the commodity. If you want delivery, then you have to inform, okay, so that they will assign the seller who will be asked to deliver. Okay, if you want delivery of this pen, there are hundreds of parties, I have to assign somebody who will deliver this pen to me. DP forward this request to the registrar and then to the transfer agent. Transfer agent, after verifying the authenticity of the request, passes the details of delivery to the warehouse. After thorough identification check, warehouse arranges the delivery of the concerned goods to the designated buyer. So one should submit all the relevant documents, then you can take the delivery from the warehouse. So this is about a brief introduction of delivery based commodities. Now the next is option trading in derivative. For your general knowledge, option trading was not there earlier. It has been started only recently in commodities, and that is why this paragraph has come in your notes also, that recently SEBI has allowed option trading in commodity future market. So there are two types of option, call, put, all that logic applies here also. So directly come to the point, on the expiry date, if option ends in out of the money, OTM, out of the money, just write off also, out of the money. If the option ends in out of the money, OTM. Now first of all, quickly revise what is out of money. It is not profitable to exercise the option. It is not profitable to exercise the option. More specifically, if it is a call option, the market price is below the exercise price. If it is a put option, the market price is above the exercise price. So that is out of money. Option will lapse. At out of money, option would lapse. So unless you know out of money, you can't read this sentence. I'll read again. On expiry, if the option ends in out of money, means it will lapse. It will be squared off at loss. So whatever premium you have paid, loss, and the holder of in the money position will have a choice either to square it off at profit or get converted into a future contract. In case of in the money, either you take the profit or convert it into a future contract. Is it right? This is the current position. Once it is converted into future contract, it will be subject to margin requirement as any other future contract. Margin requirement we have discussed in the earlier chapter. Is it right? So right now option trading is also allowed, and like any other option you can do the trading here also. But here in case of commodity, if you are making profit, either you take the profit or you get it converted into a future contract. And then if it is future contract, all margin requirements will apply. Now what the institute have done, they have made a small summary of the critical terms that are used in derivative trading. Okay, so this you must have studied in the group 1 SFM, all these terms. Once again, short position in a contract means the party who agrees to deliver or sell the contracted commodity. So short position means you want to sell, you have agreed to sell, and this position you take when you expect the prices to fall. Long position in the contract means the party who agrees to receive or purchase the contracted commodity. Then point number C, future contract. What is a future contract? Future contract is a formal agreement because it is through the exchange. Okay, where one party agrees to take a short position and the other party assumes the long position on the contracted commodity. That means it is an agreement to buy or sell, and that is through a organized and recognized exchange. The contract will specify the quantity in case of commodity, quality also of the commodity, the specific price per unit, and the date and the method of delivery. So when you take a position in commodity market, you have to tick following items: quantity, quality, commodity, price, the expiry date, okay, method of delivery. Future is a derivative contract. Wow, after the whole chapter is over, then they decided to write this line. Next line, settlement. The closeout day of the future contract is called settlement date. Last date or expiry date is settlement date. On that day, the position will get wound up, closed, and profit or loss will be transferred to the parties, usually in cash. Profits and loss are usually transferred in cash. And what about the margin? About margin we have discussed. We have taken problem also. You have to pay initial margin when you enter into a future contract, which may range from 5 to 15% of the contract value. Margin is to protect the interest of the exchange. Margin is to ensure that parties will honor the contract. If you do not pay, your margin will be used to make the payment. Okay. More about margin in the previous chapter you can refer, or you want me to take a problem again? No? Okay. Even I don't want to take. Open position. Open means this is the opening price of the trade. That is, at this price the market opened in the morning at whatever time, 10 a.m. High means it was the highest price during the trading session, highest price during the day. This is up to which the price had gone up. So it will help you to understand the volatility. And low means this is the lowest price which that commodity touched on that particular trading session or day. Then open interest means number of open positions of the contract. How many contracts are not yet settled? How many contracts are? That means parties have entered into contract, but it is not yet settled. They are still outstanding. So they will say open interest is 5,000 trades or contracts. Means 5,000 contracts are still to be settled for this particular commodity. So that shows the interest or the volume of the traders in that commodity. An expiry date means the closure date. On this date, the transaction or the contract will be closed. Winner will get, loser will pay. LTP, last traded price, means what was the price at which the trading took place at the end of the day when the market closed. And unit traded means the unit of measurement. For example, cotton will be measured in bales. So for different commodities there may be different units. What about oil? Maybe liters or barrels. Is it right? For some items, tons. For gold, grams or kgs in the commodity market. So they will say so many kgs of gold was traded, so many tons of wheat was traded in the commodity market. Okay. So every item has been given some kind of unit, and in that unit the traders will discuss and participate. Next paragraph, role of derivative. So there are three types of derivative they have mentioned there: forward, future, etc. Forward contract, as you know, is an over the counter contract. It is not through an organized exchange. The two parties, you two friends, can also today enter into a contract to buy or sell a specific quantity of a specific commodity at a specific price on a specified day in future. So that is forward contract. But forward contract has a risk of default. Counterparty may fail to deliver, fail to pay, possible. So to avoid that default risk, it is better to trade through an organized exchange, that is called future. So when the forward is traded on the exchange, it becomes future contract. It's a standardized forward contract. Why it's standardized? Because it is through an exchange, and many terms and conditions are standardized. What will be the lot size? Standardized. You can't say I want 55 units of this item. No. Lot size. In that lots you have to deal. Trading hours are decided. Margin money is decided. The settlement dates are decided. Accordingly you have to decide. Only what you need to decide: the price, quantity, commodity, okay, expiry date. There are some expiry dates available that you have to decide. One of the innovations in the field of finance is exchange traded commodities. Exchange traded commodities means these are the derivative products or financial products which are traded on an exchange, and they reflect the price of a commodity. They reflect the price of a commodity or a basket of commodities. Okay. So you don't, suppose you want to, let us say, buy gold, but you don't actually want to buy physical gold. So you can benefit from movement of gold price by purchasing an gold ETC, which will track the gold price, or zinc or tin or aluminium or such commodity ETCs. Okay, so that is about exchange traded commodity. Write down few lines I have added later in the, you will require a notebook because this much you have to write. Note on ETC. Note on ETC. ETC means exchange traded commodities. Exchange traded commodities. First write down if you want to invest only in a commodity, you must buy an ETC. Understood? You're not physically buying the commodity, but you can buy an ETC whose value will vary as the price of commodity would change. So you don't have the headache of storage. You don't have the headache of insurance. You don't have the headache that somebody would steal that commodity. Only it will be represented by ETC. So as the value of the commodity goes up, comes down, ETC value comes down, goes up. There are ETCs. You can just keep writing ETC, okay? There are ETCs for precious metals, industrial metals, oil, natural gas, then you delete this, and livestock. Even on livestock also. I don't know. I will have to check, so I have removed it. Why you ask those questions only which are difficult? You should have asked what is livestock. Huh? He knows that. What is livestock? If you would have asked, then I would say you are also a livestock only. A type of livestock. Little more educated livestock. Traded like a stock. Traded like a stock. So ETC is like a stock only, bought and sold on a stock exchange. Bought and sold on a stock exchange. Next line, right? You can take a full stop here. Go to the next paragraph. ETCs track the price movement of commodities. Have you heard ETF? Exchange traded funds, which we'll discuss in the next chapter or in mutual fund chapter. So they are like that only. ETCs track the price movement of commodities such as oil, gold and silver, and then fluctuate in value based on those commodities. And then fluctuate in value based on those commodities. Then ETC may track individual commodities and oblique or a commodity basket. You can track individual commodity or a group of commodities. ETC provides an easy, low cost way to invest in commodities. Understood? Easy, low cost way of investing in commodities. You don't have the storage headache. Okay, remember, you're not actually going to buy the gold and keep it in the locker. Just buy ETC. Okay, you don't have to take insurance also. It is just a financial product. But you get the same benefit which you will get by holding the gold. As the gold prices, silver prices would change, the corresponding ETC value will also change. Now in your notes it is printed, so relax, don't write. The Hanya, I don't know whether it is traded or not. If it is traded, then it is like that only. It is tracking the 10 commodities. So there are some index which, so don't bother. So come to the notebook, come to the notes. Next 3 lines are printed in your notes. Exchange traded commodities are the commodities that are contracted at based on ETF. They track the performance of underlying commodity index, including total return indices based on a single commodity. So I have already explained in detail the same 3 lines. Okay. So these are the exchange traded commodities. They track commodity or group of commodities, and it is easy to invest in ETC rather than physical commodity. Suppose you think silver price will rise. To keep silver at your home or in the locker, all associated cost will be there. Instead of that, you can take an ETC on silver. If you want to think oil price will rise, are you going to store oil in your tanker? No, you can take ETC. These are innovation in the field of finance. But here you are actually purchasing and then selling. They convert into small units. It's like mutual fund units of some value. You buy it and you later sell it also. Profit will be like that, but in case of future, the amount of money that you pay is just a margin money and you settle the difference in cash. Here they give you units like in mutual fund. So you hold 100 units of ETC. So this is the value. You sell it after a month. The price goes up 100 into the market price. That is what you receive. So they convert it into a kind of financial product which you can trade. Next, paragraph 5, global commodity exchanges. Again repetition. London Metal Exchange. In 3 chapters it has come so far. I can't promise what will happen in the remaining chapters. The iconic London Metal Exchange, popularly known as LME, is the world's largest future exchange market. This is one feature. Second, established in 1877, when Great Britain was at the peak of its glory. Are they explaining London Metal Exchange or are they praising Great Britain? With half the world under the British Empire, London had become the epicenter of commodity trades of all kinds. So this is very simple. And shortly, the Industrial Revolution further spurred the growth of markets for metals like copper, tin and aluminium. The growth in the derivative market for commodities actually started after the Industrial Revolution, because then people required a lot of metals like this copper, tin, aluminium. The 3-month contract, which is now considered as the standard period of a future. So future has a standard maturity of normally 3 months, which was actually born out of the time frame. And what was the logic of that 3 month? Very interesting. That took copper to be shipped from Chile to UK. Is it right? It took 3 months to transport from one location to other, and accordingly they decided that the future will have a 3-month maturity period. And then opening of Suez Canal in 1869 similarly reduced the time for shipment of tin to arrive from Malaya to 3 months, which gave rise to 3-month contract now in vogue. So now my query for last so many years have been satisfied. Why 3 months is the maturity of a future contract? It took 3 months to transport copper or tin from one country to another country. LME was acquired in 2012 by Hong Kong Exchange. This we have studied in first chapter also. So LME has got acquired by Hong Kong Exchange and Clearing Limited, and a new custom clearing house was designed and introduced to bring technology into global metal trade platform. Today, LME set the standard for operating in the commodity market within the framework of corporate governance. So this is one of the most efficient commodity exchanges, especially in the metal segment. Okay. Next line. LME has an operational committee for each of the metal traded. So they have a separate committee for each metal. Aluminium committee. Wow. Aluminium. Molybdenum committee for molybdenum, and so on. It is a kind of metal, but we are CAs. That much knowledge is enough. LME also has an elaborate ring disciplinary committee. It is for those people who trade in the ring, and an appeal mechanism for both traders and members in place. LME price discovery mechanism works in all the three ways. So what are the three ways? One is open outcry system. That means there is a ring, means trading ring, where the traders assemble, shout, okay, and then they decide what is the contract price. So this is verbal method, traditional method. Still in some exchanges, in some segment they follow this convention or the tradition. Then LME Select, it is the name of the electronic trading platform of LME, an inter-office telephone market system. That means you can also trade in using telephone network. These are the three ways the prices are determined. So open outcry system still exists in LME. LME is active for trading 24 hours a day because it's based on online trading. Then there is a common misconception that precious metals like gold are traded on LME. So today remove that misconception. They are not. Gold is not traded on LME. Other metals are traded. The name of the exchange is London Metal Exchange. So people may think gold is traded, but they are not. What is the main item they trade? Ferrous and non-ferrous metal. Whereas gold and silver are traded on the OTC, over the counter, managed by London Bullion Market. So this is about LME. Now come to another exchange, tick mark Eurex exchange. I think in one MCQ I have seen that is given in some multiple choice question. Eurex exchange. In some model test paper it is there. Eurex is the largest European, EUR means European, EX means exchange. Eurex exchange is the largest European future and option market, and this is located in Germany. One of the foremost exchange to usher in electronic trading. Its trading platform is called T7, is considered to be the best in the world. But this line has appeared for many other exchange also. Best in the world, okay? No. They have written that BSC platform is the best. NSC is also the best. MCX is also the best. NASDAQ is also the best. Anyway, I don't think they will ask this question in the exam. It is one of the best. I think the best way to describe anything on this earth is one of the best. Okay, diplomatically. Eurex is constantly pushing itself to explore new areas and product classes. So what they are doing, they are trying to bring more innovation. They have introduced a factor index based future that allows investor to trade 6 individual risk factors in future format. The 6 factors are size, value, carry, momentum, low risk and quality, and is a dynamic attempt to allocate to alternate sources of beta in an attempt to deliver equity like returns with low correlation. Please do not ask me the meaning of this paragraph. So much of complicated terms they have used together. So they have created an index which gives you equity like returns, and this is based on some factors like what is the size, value, carry, momentum, low risk, quality. Next line is Chicago Mercantile Exchange Group. This was there in earlier chapter also. Chicago Mercantile Exchange and Chicago Board of Trade is the US based largest future and option platform for trading. Okay. So this is based in USA, and in USA it is the largest future and option trading platform. Again, it is a very old exchange established in 1898, offers the entire bouquet of trade based on few ferrous, non-ferrous metal, precious metal, and even on weather and real estate. So if you want to bet on weather, tomorrow there will be rain, go to Chicago Mercantile Exchange. Okay. So in some exchange, even weather is traded. In some exchange, carbon credits are also traded. Carbon credit trading. The acquisition of New York Mercantile Exchange (NYMEX) by the CME Group in 2007 catapulted it into number 1 stated in US. So now it is 1 because it has acquired this NYSE. The platform also allows for agri-based commodity contracts like class 4 milk, class 3 milk. This also you can trade there. Feeder cattle. Tick mark this paragraph because there is a question on this paragraph you will find in your model test paper and past exam. What is the system known as which is used by CME? So you have to write SPAN. CME has developed SPAN. What is SPAN? Standard Portfolio Analysis of Risk. In fact, that is used by NSE also now. And this helps us to calculate the margin that will be required for future. Through a software, the margin calculation is done, and that software is known as Standard Portfolio Analysis of Risk. You put the data in that, and accordingly the software tells you how much margin is required, which has been adopted by many agencies. I told you, even the NSC uses this as a benchmark software across the globe. And then your institute has written this paragraph. Students are advised to supplement this chapter with the topic of commodity derivative from the study material of strategic financial management paper. So commodity derivative which you have learned in SFM, the entire chapter is applicable to you. Still I have taken many questions from that topic. 2 more questions I will take below from your ICI study material. Test your knowledge. First question, explain how commodity derivatives are different from financial derivative. So the answer is printed in the book on 3rd page of this chapter, para 4. Write class note, page 3, para 4. Para 4.1, more specific. Class note, page 3, para 4.1. A direct question can be asked for 1 or 2 mark. Which is the standardized software to calculate margin requirement for future developed by CME, adopted by many agencies as benchmark software across the globe? Right, SPAN. Just now you have read. So as I said, this question was there in one of the ICI material, somewhere I had seen. This is the place. And one more numerical question they have asked. A company is long on. What is long on? Purchased. This was an exam question for 4 marks also in commodity derivative SFM. A company is long on 10 metric ton of copper at rupees 474 per kg spot and intends to remain so for the ensuing quarter. Is it right? The standard deviation of changes of its spot and future prices are 4% and 6% respectively. Correlation coefficient is 0.75. What is the hedge ratio? What is the amount of copper future it should short to achieve a perfect hedge? Does it remind you of one problem I have solved in the previous chapter? Yes. Formula for hedge ratio. Anybody? Formula for hedge ratio. Correlation between the spot and the future price into standard deviation of the spot price upon the standard deviation of the future price. This formula tells you what position in future required to hedge 1 unit of spot. Okay. Solve. Just 2 minutes. You want to write in the book only? There is no space. Write in notebook. What will you do after saving so much money? Anybody got the answer? 0.5. Sometimes you are right. So 0.5. Answer is not over, but still you'll get 1 mark for this much effort. Okay. Hedge ratio is 0.5. It indicates that if the future price changes by 1%, the underlying value changes by 0.5%. It also tells you that if you have a 1 unit exposure in the underlying, you have to take 0.5 exposure in the future. Yes or no? So position in the cash market multiplied by hedge ratio is the position required in the future market. So write a note just for understanding. In the exam, they were very kind to tell you that what is the amount of copper future it should short. Actually, the question they should ask, what is the position in the copper future you need to take? Now you have already bought the copper. So what is your risk? Price may fall. If you are holding something physically, then the risk is that its price may fall. And if you want to hedge, you have to short the future. If price falls, you would lose on that commodity which you are holding, but you'll gain in the future market. So therefore the note says you should go short on future to hedge the risk. Suppose in the exam the problem said what position would you take in future market? So if I am holding a commodity, means I am long on a commodity, I need to short the future. Now the next question was, what is the amount of copper future it should short to hedge, to achieve a perfect hedge? So the last part of this wonderful question, calculation of number of metric ton of future contract to be sold. Calculation of number of metric ton of future contract to be sold. Right hand side quantity. What is the spot position in metric ton? 10. Hedge ratio 0.5 over multiply future position required in metric ton future position required in metric ton A into B is 5. Okay. Future position required in metric ton is 5. And now one more line write down, value of future contract to be shorted. So we have answered in both quantity and value. Institute may ask for quantity or institute may ask for value. Give them both. When you are in doubt, be Hanuman. Give everything. That's a wise strategy. So value of future contract to be shorted, 5 ton means 5000 kgs, because in the problem you are given 474 per kg. So multiply by 5000 kgs. So this is the value of future contract you have to go short. Right. Now I'm just going to take one more general problem on this topic, which I took in the earlier chapter also. Write down. In case if you have passed group 1 some years back and you are not able to recollect, this question is useful to you. Gold is being sold in the spot market. Gold is sold in the spot market at rupees 16,000 per 10 gram. Is right? It is traded on the basis of 3-month maturity future contract. It is traded on the basis of 3-month maturity future contract at rupees 16,800. An operator can borrow money at 10% per annum. An operator can borrow money at 10% per annum. If nothing is given, assume continuous compounding. If nothing is given, assume continuous compounding formula, e to the power RT. Cost of warehousing of 10 grams gold for 3 months is rupees 300, payable upfront. What is payable upfront? Means in the beginning only. It means you have to first purchase gold for 16,000 and you have to also spend immediately 300 rupees for storage. Do not calculate present value of storage cost. It is already written payable upfront, means it is the present value. Okay, you have to pay in advance. Is there some arbitrage opportunity? Okay, in the notebook you are writing. What we will do, like we did in the earlier problem in chapter number 6, this is the spot price, this is the storage cost, add, this is your time value of money. Find out what would be the theoretical future price of gold future. Compare it with actual price. If there is a difference, arbitrage opportunity will arise, and then we have to write whether we need to buy future or sell future. Dear student, write down. First, write down calculation of theoretical future price. Calculation of theoretical future price. Spot price is given, storage cost already given in present value terms. So add the two, 16,000 plus 300 into the value of E is 2.7183, R 0.10 into P 3 by 12. Solve. Anybody wants to answer? Right. So something like 16,712, round off. 16,712 approximately you are getting. So all of you are getting 16,712. You should be able to solve such calculations. In the exam mostly they will give you this factor, but even if they don't give you, you should be able to solve. Got it? Now write down step 2. Actual future price equal to rupees 16,800. Rupees 16,800. Then step 3, evaluation. Evaluation, right? Actual future price is more than equilibrium future price. Is more than equilibrium future price. Therefore, future is overvalued. Future is overvalued. 16,800 is more than our calculated answer. So what strategy will you adopt here? Strategy, write down. Buy spot, sell future. Now I am going to execute the strategy also. That means I will tell you exactly what you will do today and after 3 months and how you are going to make the profit out of it. Suppose they say carry out the arbitrage process. Suppose they say carry out the arbitrage process. So you will say sell future at rupees 16,800. No problem. And then what you will have to do? You have to borrow rupees 16,300. Why 16,300? 16,000 you will pay to buy gold. 300 rupees you will pay for storage. Okay, you need 16,300 rupees for storage and gold for 3 months at 10% CCRRI. What is CCRRI? Continuous compounding risk-free rate of interest. Continuous compounding risk-free rate of interest. If your original answer is based on CCRRI, this strategy will also be based on CCRRI. Otherwise, the two answers may not match. Okay? Yes or no? Point number 3. Buy spot gold. You have 16,300 rupees from the bank. Don't put your own money. Borrow. Buy gold. 16,000 and pay 300 rupees storage cost. Now my question is, we have to see whether on the expiry date will I suffer loss or will I have gain. We will have gain, but then I have to demonstrate. Okay, so now write down one more heading, calculation of arbitrage gain. If they ask you carry out the arbitrage process, they will write a case study. Mr. Mohan is fascinated with commodity market. He found that gold is trading at 16,000 rupees. He can borrow from the bank at 10%. This way they will design a long story. Carry out the arbitrage process. So we will draw 2 columns on the right side now and on maturity. So first point number A, borrow. So first you write in now column borrow 16,300. Then in next line write B, purchase gold 16,000. Point C, pay storage cost 300. So what is your cash flow now? 0, because what you borrowed, you used it for buying gold and used it for paying the storage cost. Now on maturity, what will happen? You have entered into a future contract to sell gold at 16,800. Is it right? So you have gold with you. Sell it and recover. How much? 16,800. Then go to the bank. Take your money with interest. And you will be left with some difference. So now next point, write down. Net realization from future settlement 16,800. Future contract in this example means you have a right to sell 10 grams of gold at 16,800. You've written a sell future. Right to sell at 16,800 10 grams of gold. And you are holding the gold also with you, 10 grams of gold in step number B. So that gold you have delivered. Now you don't have any gold left with you. Go to the bank. Tell the bank, thank you. Thank you for lending me. Take your 16,300 into e to the power RT, means it is interest. Don't calculate again. Good student will go to step 1 and he will see what was the answer for 16,300 into e to the power RT. He will find 16,712. If you take other interest rate, it may not match. Be careful. What you will use in first answer, you have to use it here only. And therefore write down arbitrage gain. Today 0, but after 3 months you will have a surplus of 88 rupees. For every 10 gram, 88 rupees. Then why 10 gram? Mr. Mohan should buy 10 tons of gold only. Huh? It is a future market. You don't have to actually do physical transactions. Anyway, this answer is over. And this chapter is also over.